How does a massive new partnership with Amazon suddenly drop an $85 million per quarter revenue engine right into a legacy bank's lap?
It is pretty wild.
Right. Welcome, everyone, and thank you so much for coming to watch the video today. We are doing a deep dive into U.S. Bancorp's Q1 2026 earnings. So to kick us off, could you just summarize their prepared presentation for us?
Yeah, absolutely. I mean, the numbers they're putting up are honestly staggering. Their earnings per share hit $1.18,
Wow.
which is up 15% year over year, and that drove total net revenue to $7.3 billion. But what really stands out is the 4.1% growth in net interest income, plus a second consecutive quarter of record consumer deposits. Oh, and this massive positive operating leverage of 440 basis points.
Okay, wait, let's unpack this a bit, because operating leverage of 440 basis points sounds like, financial alphabet soup. Basically, they are growing their revenue significantly faster than their expenses, right?
Exactly. They are widening that profit gap. And their full year guidance projects 4 to 6% revenue growth while maintaining over 200 basis points of positive operating leverage.
Which brings us to how they are actually doing it. It's like a chess game, or, well, maybe building a highly efficient toll road. They leverage that California scale from the Union Bank deal, that's the physical road. Then they acquire BT to beef up capital markets, and now they launch this Amazon small business card right on top of it.
Right, to drive immediate high margin traffic.
Exactly. Before we get into the Q&A where analysts really grilled them on this, I want to quickly remind you watching to stick around. We are about to unpack some highly anticipated insights on AI risks and private credit, and you definitely don't want to miss it.
Yeah, the Q&A was packed. So starting off, Scott Seifers from Piper Sandler asked about that operating leverage and loan demand.
And what was management's take?
They expect mid-single-digit loan growth, mostly driven by healthy core capex and expansion.
Okay, got it. What about John Pancari at Evercore ISI? He asked about margin progression and capital priorities,
They
right?
did. They are targeting a 3% margin by 2027, and they are starting share buybacks at $200 million per quarter.
Nice. Then John McDonald from Truist jumped in. I think he wanted them to clarify revenue guidance and the BPI timing.
Yeah, management said they actually have a bias toward the high end for fee revenue, and they noted BTI will be accretive in the back half of the year.
Okay. Ibrahim Poonawala at BOFO asked about Cat 2 regulations and, siding up that Amazon deal.
Right, well, they said they are fully prepared for Tattoo and the Amazon deal. It brings $1.6 billion in loans and 70,000 clients by Q3.
Wow, 70,000 clients. That is
Yeah.
massive. So Mike Mayo from Wells Fargo, he asked about top investment priorities.
He did. They are focused on fee growth, the consumer franchise, and becoming an AI native organization.
AI native, right. Which makes me think of Erica Najarian at UBS. She asked if deposit costs can hold if the Fed doesn't cut rates.
Yes, and their response was really interesting. They plan to do that by strategically shedding high-cost institutional CDs.
Smart, flushing out the hot money. Ken Usdin from Autonomous, he asked about the pace of expense growth.
Right. They said they are flexing marketing and tech investments, but strictly maintaining that positive operating leverage we talked about.
Gotcha. Gerard Cassidy at RBC asked about their physical branch strategy and also NDFI loan risks, basically private credit.
Yeah, they are densifying branches in high-growth markets like Phoenix. And for NDFI, the portfolio is highly collateralized with a very low likelihood of loss.
Okay. Saul Martinez at HSBC asked about merchant processing volumes and Amazon's potential.
They clarify that the merchant volume softness was just one or two clients exiting. And obviously, Amazon offers this massive pathway to broader banking relationships.
Right. Vivek Juneja from JP Morgan asked about the corporate payments slowdown. Was that a big issue?
Not really. They are simply lapping a unique surge in government spending from last year.
That makes sense. David Chiarini at Jefferies brought up AI disruption risks to fee income.
Yeah, but management isn't seeing mass disruption. Instead, they are using AI offensively to simplify complex internal operations.
And finally, Chris McGrady at KBW asked about non-bank lending competition.
They noted their growth is coming from traditional corporate sectors, like food and energy, not by directly competing with private credit.
Wow, so many moving parts. So to give a high-level wrap-up, what are the main themes here?
The main themes are highly resilient core loan growth, deposit stability despite all the rate uncertainty, and aggressive forward-looking investments via partnerships.
Incredible. Well, thank you all so much for watching. If you liked the video, please click like, share the video, subscribe, and stay tuned for upcoming content.
Definitely.
And I'll leave you with this final thought. If massive, highly regulated legacy banks successfully transform into AI-native organizations, will they completely erase the operational advantages of nimble fintech startups?